we have in store for you 1 credit hour, 50 clock minutes of an ANA update. So on our first slide here, we're going to walk through our learning objectives, where after completing this course, you should be able to identify some of the recent accounting hot topics. We're going to cover some financial reporting updates and discuss some things that are coming out from our regulators. So for our agenda on the next slide, we're going to be first go through some accounting updates from the FASB. We're going to roll into some recently effective ASUs, and then we're going to round out our session with a little bit on the FASB's technical agenda to see what's on the horizon from an accounting standpoint. All right, with that, let's jump into a little bit of a discussion of the recently issued FASB standards. So here we have just 5 of them laid out. These are ones that were issued in the last year. We will cover the substantive updates in detail over the next several slides. The first one that we're going to take a deeper dive into will be our induced conversions of debt instruments. But before we get into that, let's take a look on the next slide at some recently issued FASB standards. So these are things that are recently issued, but maybe not quite yet effective. So we'll have a little bit more time to maybe contemplate how these might affect tips. But with that, let's jump into our first meaningful topic, which is the induced conversion of debt. So the FASB board issued this update with the goal of improving the relevance and maybe more so the consistency in how companies are applying the induced conversion guidance. This guidance resides in topic 470-20, which is the debt and debt with conversion options. So when the terms of a convertible debt instrument are changed to induce conversion of that instrument, GAAP provides guidance for determining whether that transaction should be accounted for as either an induced conversion or an extinguishment, and they have sort of different accounting ramifications. The induced conversion guidance was originally written in the context of shares settled convertible debt before cash convertible instruments became as prevalent are they today in practice. So that fact, as well as some other amendments that came from ASU 2020-06, which is a real landmark change to this category of debt guidance. Those two things have resulted in several questions from stakeholders about how to determine if the settlement of convertible debt it qualifies under the original inducement guidelines, or it should be accounted for as an extinguishment. And again, the accounting ramifications of either of those options are meaningfully different. So on the next slide, we're going to cover just some of the current guidance. So prior to this ASU, the guidance on induced conversions applies only to conversions that included the issuance of all equity securities issuable pursuant to the conversion terms or privileges provided in the original debt agreement at issuance. The current GAAP didn't endeavor to address how this criteria should be applied to the settlement of convertible debt that does not require the issuance of equity securities. So for example, a convertible debt instrument with a cash conversion feature just wasn't contemplated in this guidance. Current GAAP also did not address how adding or eliminating or modifying VWAP, which is the volume weighted average price formula, interacts with this criteria, including when those changes could result in the holder receiving less than the amount of shares they would have received if the instrument had been settled pursuant to the unmodified conversion terms in the original instrument. And so VWAP settlement mechanics are extremely common in practice, and it just, again, wasn't addressed in the guidance. So stakeholders basically just said that the current GAAP isn't clear on how these considerations should interact with the settlement conclusions as either being an extinguishment or an inducement. So then on the next slide, the amendments in the ASU endeavored to clarify these requirements on whether it should be accounted for as an inducement. So under the amendments to account for a settlement of convertible debt as an inducement offer is required to provide the debt holder with, at least at a minimum, the consideration issuable under the original conversion terms provided in the debt instrument. And the entity now needs to assess whether this criteria is satisfied as of the date of the inducement offer is accepted by the holder. So that was one point of clarification, is that at what point do you look at the change in the value of the consideration? And the ASU clarified that it's done as of the date the offer is accepted. So if and when it's applicable, the convertible debt instrument has been exchanged or modified within 1 year, you look at both the inducement date as well as you go back to the 1 year period to make your overall assessment. So the amendments do not change the other criteria that are required to satisfy the settlement as an inducement versus an extension. So then I think on the next slide, we're just going to cover some more info on the new guidance. So the amendments also make some maybe additional clarifications to assist companies in applying the guidance. So additionally, under the amendments, the incorporation, so adding or eliminating or modifying a VWAP formula does not automatically cause the settlement to be accounted for as an extinguishment. And some companies in practice were applying that threshold. And so it's clarified that does not automatically get you to extinguishment conclusion. The entity should instead assess whether the form and amount of the conversion considerations are preserved, that is provided for in the inducement offer, using the fair value against these shares as of the date the offer of inducement is accepted. So the amendment also clarifies that the induced conversion guidance applies to convertible debt instruments that are not currently convertible, as long as it had a substantive conversion feature as of both the issuance date and the date the conversion offer is accepted. So a lot of those details, again, just weren't contemplated in the guidance. So the FASB provided some maybe additional framework for making those inducement decisions. I think my last slide on the inducement topic is just some transitional guidance. So it does apply to all entities that settle convertible debt instruments for which the conversion privileges were changed to induced conversion. And the effective date for all entities will be annual periods beginning after December 15th, 2025, and for interim periods within those annual years. So early adoption is permitted for entities that also have adopted 2020-06, which is the, like I said, as I mentioned a moment ago, which is a much more sort of landmark change to the debt and equity guidance. I'm sorry, maybe one more note on transition on my last slide. The amendments in this update do permit the entity to apply the new guidance on either a prospective or retrospective basis. Under the prospective transition approach, the entity would apply the amendments in this update to any settlement of convertible debt that occur after the effective date of the guidance. And under the retrospective approach, the entity would recast prior periods and recognize a cumulative effect adjustment on equity as of the later of either the beginning of the earliest period presented or the date the entity adopted the 2020-06 guidance. So that is, an entity would not be permitted to apply the amendments in this update retrospectively to settlements that occurred before the adoption of 2020-06. I do think in practice, we're happy to discuss how these amendments might affect your business. I think in practice, I would expect most entities to just do a prospective adoption of this STEM. All right, I think moving on to our next topic, we have an update on disaggregating of some expense disclosures. So this is mostly a timing change or clarification of the timing change going back to a previously issued standard. So this ASU, which is 2501, it just amends the effective date of an update from last year, which was 2403, to clarify that all public business entities are required to adopt the new guidance for the disaggregation of income statement expenses in annual reporting periods beginning after December 15, 2026, and interim periods within annual years and beginning after December 15, 27. So early adoption of the 2403 standard is permitted. The originally issued language, which is thought to be a little unclear regarding the periods of adoption. So maybe taking a little bit of a step back on the 2024-03 standard, that was issued to improve the disclosure around public business entities' expenses and address requests from investors to provide a little bit more detailed information about the types of expenses. So things like purchases of inventory, employee comp, other things like depreciation and amortization have a little bit more guidance under this new standard. And the standard just gives a little bit more guidance on how to present those items as either cost of sales or cost of revenue versus like an SG&A or research and development. And the next ASU from 2502, this is an update to SAB topics. So SAB topics are issued by the SEC and solely cover issuer financial statements. So under SAB topic 5FF, which covers accounting for obligations to safeguard crypto assets, an entity holds on its platforms on behalf of its users. In January of 25, the SEC issued the staff accounting bulletin to rescind this prior guidance. And now is being reflected by the FASB as an ASU. So at a high level, the old SAB topic 5FF was not out there in practice for too many years, but it did establish that companies who hold crypto assets on behalf of others record a liability on their balance sheet representing the assets that they hold for someone else. And this ASU and the SEC action rescinds that guidance, and they no longer have to record that safeguarding that. So if you're in the crypto space and you're interested in the SAB topics on there, please reach out. We do have a whole person that's dedicated to crypto and other digital assets.
Awesome. So so just going to continue going through the updates that have been issued in 2025. The third one that was issued this year deals with determining the accounting acquirer in the specific circumstances that the acquisition involves a variable interest entity. And so normally in business combination is they're part of one of the first steps you have to accomplish is determining who's the accounting acquirer and the acquiree, and that will then impact how you're recording that business combination. So given that this is impactful to the combined entity's assets and liabilities, it can also impact that income. There had been some indications from stakeholders that determining the accounting acquirer in the instance that a variable interest entity is involved seems to sometimes produce kind of a lack of comparability between transactions that involve VIEs and those transactions that don't involve VIEs. And so specifically stakeholders noting that if the legal acquiree is a VIE, then the transaction can't be accounted for. It has a reverse position. It's not the case if it weren't one of those entities. And they also noted that current guidance would affect not only the determination of which entity is the accounting acquirer, but also whether a business combination has occurred at the beginning of their assessment. So diving a little bit deeper into the current guidance that this update will amend, in situations where there is a business combination and the acquired entity is not a VIE, then it is important basically for an entity to go through a list of factors and considering who the accounting acquirer should be. And so an entity may determine that a transaction is a reverse acquisition as part of this, where the legal acquirer is identified as the acquiree for accounting purposes. Also in the consideration of these factors, an entity may determine that the transaction actually isn't a business combination at all, because the acquiree is not a business. So that would be an asset acquisition. The current guidance will then shift and basically say, okay, you kind of have this one path to go down when you're acquiring an entity that is not a VIE by considering this list of factors. If the entity that's being acquired is a VIE, then you go down another path. And under the current guidance, the primary beneficiary for the VIE would be the accounting acquirer in all circumstances. And so, as you may recall, under the variable interest entity guidance, the primary beneficiary is the one entity that is consolidating the VIE on their books currently. So the new guidance is going to replace the requirements that the primary beneficiary will always be the accounting acquirer. And instead of having kind of the branching assessment when determining accounting acquirer based on whether the acquired entity is a VIE or not, it is going to align the two processes to basically follow the same assessment and considering certain factors that are laid out in paragraphs 5512 and 5515. That's part of ASC topic 305. So more or less an alignment here. The idea being to hopefully create more comparative information when you think about business combinations and who's the accounting acquirer instead of having those diverging paths. The new guidance will also require an assessment when the legal acquirer is a VIE that meets the definition of a business. So go through that assessment when that is the case. Otherwise, you'll be kind of reverting to the asset acquisition guidance. From an adoption perspective, the board has come out and said this is going to apply to any entities that are involved in these type of acquisition transactions. And when the VIE that's being potentially acquired is considered a business, the effective date will be those annual periods beginning, after December 15th, 2026, and then admin periods within those annual periods. Early adoption is permitted as of the beginning of an interim or annual period, depending on what an entity elects and how to adopt this. And finally, from a transition perspective, the board is requiring that this be adopted prospectively. So really, once the effective date has happened and passed, and companies have adopted the amendments, the next acquisition transactions that occur after that initial application date should now be considered under the new guidance from Update 2503. Update 2504 deals with clarifications for share-based consideration and then payable to a customer. And so this, again, kind of similar to the previous one, is attempting to eliminate some diversity in practice and improve decision usefulness and operability of the guidance for share-based consideration. Share-based consideration gets a lot of attention, and it's kind of a complex situation of accounting. And there have been times where entities were bringing up that they're offering to provide consideration to a customer that will essentially incentivize those customers to purchase goods and services. So although the consideration that's payable to that customer will sometimes take the form of cash or credit that can be applied, entities are also using basically their own equity instruments to use as incentives. And so when an entity is granting this type of share-based consideration to help incentivize, sales of their goods and services, they may add vesting conditions such as the grantee or the customer who's receiving that equity instrument, it will vest if they buy a certain amount from a monetary perspective, or if they buy a certain volume of their goods, and then they'll basically be able to use the equity instrument as it's being granted to them. What happens under these considerations is when you think about revenue recognition guidance and how this plays in, it could potentially impact the timing of revenue recognition for the goods and services that are being provided, because you have this share-based component that's going back to the customer. And stakeholders find this confusing and looking for some clarification. So under the current guidance that kind of impact share-based consideration that's going to be paid to customers, the definitions for performance conditions and service conditions for the vesting of those equity instruments does not explicitly discuss purchases made by a customer. So just a second ago, I mentioned that some of the vesting conditions could be if a customer reaches certain purchases target. And so because it's kind of unclear as to would this be performance condition or service condition, that would then have an effect on recognizing revenue. So for performance conditions, it affects when the grantor, or in this case, the entity who's selling services, would recognize revenue due to the requirement that you have to estimate what the probable outcome is. So is the customer going to vest based on the performance condition of the share-based consideration that they're giving to the customer for incentives? And if it's considered service conditions that are part of that instrument, that would delay revenue recognition for awards that are not probable of vesting if the grantor, if the entity who's issuing the instrument, is accounting for forfeitures as they occur. In addition, the guidance around share-based consideration does not state explicitly whether the Topic 606 constraint around variable consideration is going to apply to the share-based condition that would actually be falling under ASC Topic 718 for share-based payables. So though the board took stakeholders' concerns into consideration, and the amendments that they've come up with in 2025-04 include, very first off, is revising the definition of performance condition. So now there is a specific inclusion of conditions that include thresholds of purchasing volume or purchasing specific monetary amount. Performance condition will now also incorporate these targets that are based on purchases made by other parties that will purchase from grantor's customers. So we're thinking of the supply chain. There can also be an incentive of I'm selling to a customer who's kind of reselling my goods. So I might actually want that to be getting to the end consumer. And so I'm including an incentive condition that the customers of my customers who have this instrument are getting the final product. As part of defining the condition, the board wanted to point out that this will not apply to awards that are granted to employees for good or non-employees that are for goods or services to be used in the grantor's own operations. So when you're thinking about share-based consideration that's giving to an employee or non-employee, that the entity is then basically needing to use the goods or services that that person is giving in exchange for the share-based consideration. It's using those in its own business operations to provide its own services. Those are excluded from the new guidance and kind of falling under this new performance condition. The new guidance will also eliminate the election to recognize forfeitures as they occur. And so this kind of points back to the service condition part of your delaying revenue recognition if when you're thinking about the probability of vesting, but also recording forfeitures as they occur. So now for these types of share-based consideration, the grantor who is issuing the instrument to a customer is required to estimate the number of forfeitures they expect for these types of awards, essentially. And then that will play into kind of the revenue recognition timing from their end. Kind of in a similar manner, the elimination of this election for forfeitures as they occur does not impact the election for forfeitures for awards that are granted to employees or non-employees that are being issued awards for goods or services that are going to be used in the grantor's new own operations. That is still available. And the new guidance continues to go on and clarify that the share-based consideration encompasses the same instruments as share-based payments, except the grantee does not need to be a supplier of goods to the grantor. The guidance also confirms that Topic 606 regarding the constraint of variable consideration should not be applied to share-based consideration that are payable to customers. You're going to assess the probability of the awards vest only using the guidance within Topic 718. This new guidance will apply to any entities that are issuing this type of consideration that results in a transaction within the scope of ASC 606. It'll be effective for all entities and annual periods beginning after December 15th, 2026, as well as interim periods within those annual periods. And early adoption, is again permitted as of the beginning of the interim or annual period. In the case of ASU 2504, an entity has the choice of using a modified retrospective basis of adoption by recognizing a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the period of adoption. So you don't have to recast information prior to adoption, or using a fully retrospective approach where you would recast all comparative periods that are being shown and recognizing that cumulative adjustment to the opening balance as of the earliest period presented. In the case of using the fully retrospective approach, entities are allowed to consider the actual outcome of these performance and service conditions and then how that vesting impacted the actual awards that were effective for their customers. And with that, I think we'll continue going down the list and move on to the new credit losses section. All right, thanks, Ben. So maybe just to characterize and frame ASU 2505, right? If you think back, the FASB had three of their really major landmark changes to the accounting frameworks. It was the revenue standard, one of these standard, and the third one was the credit loss standard. The credit loss standard is the most recent one that became effective. And this ASU is sort of just tweaking a little bit around the edges of how companies are to apply this new standard. So there's a lot of content here, but I think as you're listening and digesting what we're going to go through in the next several slides, just keep in mind that these are simplification and sort of practical ways the FASB is trying to allow companies to adopt and apply this new credit loss concept, right? So the board did issue this ASU to address some of the challenges companies were encountering when applying the new guidance in Topic 326, which again is the credit loss standard.
Specifically, the challenges were related to making the estimates to current accounts receivable and current contract assets that are arising from revenue transactions. The private company council initiated this project, which should give you some clue as to where this feedback was coming from. Those stakeholders and the private company council have indicated that identifying, analyzing, and documenting the microeconomic data. So this is stuff like unemployment rates, property values, among other economic data points, as part of developing their reasonable and supportable forecasts when estimated expected credit losses on these balances, that it can be costly and complex, and generally did not have a material effect on the overall estimate of expected credit losses, specifically for short-term assets. So basically they said macroeconomic conditions don't really affect my expected credit losses when I'm going to receive these receivables or contract assets within 15 to 120 days, but basically the short-term asset side of the balance sheet. So the stakeholders observed that estimating the expected credit losses for the current AR and including or acknowledging how much of those receivables were collected before the financial statements were available to be issued can require significant effort, and the documentation can result in sort of an administrative burden with applying those presumptive standards from the original credit loss standing. So the stakeholders noted that the ability to consider actual cash collections between the balance sheet date and when the financials are issued would provide relevant information for investors. So to address this feedback, the FASB issued this update to introduce a couple things. So we're going to talk about both a practical expedient and separately a policy election. And there's a mix of what's available for public and private companies. So there's a lot of detail here. So reach out to your engagement teams if you have further questions. And I am going to move a little bit swiftly through these because I do feel like the things that are afforded in this ASU are also things that many companies were including in their general process as sort of a practical matter to begin with. Right? So the current guidance before this ASU under topic 326 required that the entity would consider available information that is relevant to assessing the collectability of cash flows when developing their estimate of expected credit losses. The historical credit loss experience of financial assets with similar risk characteristics generally provides the basis for the entity's assessment of future expected credit losses. However, an entity is required to consider adjustments to that information to reflect the extent to which management would expect current conditions and reasonable and supportable forecasts may differ from the current conditions that existed as of the balance sheet date. Those adjustments may be qualitative in nature and should reflect current conditions and forecasted changes relevant to things like unemployment. It could cover property values. It could cover commodities values, delinquency rates. There's sort of a long list of macroeconomic conditions that will presumptively need to be at least considered and documented in the management assessment. So in addition to the current guidance, the entity would not consider collection activity after the balance sheet date when developing that current estimate of expected future credit losses. So this amendment is expected to provide maybe a better path for investors to get that decision useful information about what the actual expected future losses may end up being. So under the new guidance, it provides two big things. First is all entities are now provided with a practical expedient, which we're going to cover. And then entities other than public businesses are now provided with an accounting policy election when estimating expected credit losses for current accounts receivable and current contract assets, but only when they arise from revenue transactions under Topic 606. So first, the practical expedient. The practical expedient now affords companies when developing their, quote, reasonable and supportable forecasts as part of estimating expected credit losses. All entities may elect this practical expedient that assumes current conditions as of the balance sheet date do not change for the remaining life of the asset. So sort of just acknowledging the current nature and short-term nature of these assets, you can, as a practical expedient, assume there will be no changes to those economic conditions. And then second, the accounting policy election is available to any entity other than public businesses that elect the practical expedient are permitted to make an accounting policy election to consider collection activity after the balance sheet date when estimating expected credit losses, right? So we're basically allowed to consider what the subsequent cash collections are between the balance sheet date and the date the financials are available to be issued. You can include that information when making your credit loss loss. So on the next slide, the amendments in this update affect entities that apply the practical expedient in the accounting policy election when estimating the expected credit losses on current receivables as well as current contract assets. It would also include the assets acquired in business combination. So if you're bringing on receivables and contract assets at the time you're acquiring another business, this guidance can also apply there. The practical expedient may be applied to all entities, but the accounting policy election may be applied only by entities that are not public businesses. An entity that elects the practical expedient and the accounting policy election, to the extent they're applicable, should apply the amendments in this update prospectively. The amendments will be effective for annual periods beginning after December 15, 25, and interim periods with those annual reporting periods. So early adoption is permitted in both interim, again, annual reporting periods for any period for which the financial statements have not been issued. We do see a lot of upside in early adopting this one. So definitely something that you should be talking with your engagement team about. And I think my last slide on the credit loss topic is just one more note on the adoption timeline here. An entity other than a public business that elects to apply the practical expedient, you would not need to perform the preferability assessment. So there's a separate section of the accounting guidance, which is the 250-1045-2, which just says that if you're changing an accounting principle, the new principle has to be, quote, preferable over the old selection. And when you adopt this ASU, you can kind of skip over that preferability assessment and just adopt it on whatever timeline Easter Light is appropriate. Right. So with that, let me move into a new topic, which is the accounting for internal use software. This one has gotten a lot of attention among our clients and friends at the firm. So I have a meaningful amount of information to go through. The board issued this update to try and really kind of just modernize the accounting for software costs. They did get a lot of feedback from financial statement preparers and users that the current framework for software costs, it just didn't acknowledge the current reality of how software is developed. So the feedback they got indicated that the accounting for software costs should be one of the top priorities from the FASB, and they did sort of fast track this a little bit to get the standard pushed out. The feedback they got was that the FASB should consider a better alignment of how software costs or how software is being developed, because the current guidance is a little bit outdated and it lacks relevance given the evolution of software development. So specifically, many entities have shifted from using a more prescriptive and sequential method of developing software to something that's more incremental and iterative. So if you're in the software development world, many of our clients use sort of what's sometimes called an agile approach to software development. And so stakeholders suggested that the current internal use software guidance didn't address software developed under this incremental and iterative approach. And as a result, there was a little bit of diversity in practice, and there were challenges in determining when to begin capitalization under the current guidance. So looking at the current guidance before the ASU, under the current guidance, entities would be required to capitalize development costs incurred for internal use software, depending on the nature of the costs and the project stage during which those costs were incurred. Stakeholders said that applying this guidance can be a challenge because entities now have trouble differentiating between the software stages, particularly in this sort of iterative or agile development world. The amendments in the ASU are hopefully going to improve just the operability of how this guidance is applied in practice, and really just align with the current approach that that companies are using when developing the software. So the board expects that capitalization of internal use software generally will not meaningfully change significantly for most types of software under the amendments of this update. But for the development of software to be provided via a cloud computing arrangement, the board expects that the amendments could result in somewhat of a decrease in the amount that's capitalized. This decrease in the capitalization should better align with the accounting outcomes for development of software that is intended to be sold. So this would be things that would fall under an on-premise model, which is covered by a different topic, which is 985. And so this amendment should better align the software rules for software that is intended to be sold and for software that is intended to be internal use. So a little bit more on the current guidance. Thank you, Ben. The amendments in this update remove any reference to the prescriptive and sequential development stages. So these were previously referred to as the project stage guidance, which was in 350-40. Therefore, companies are now required to start capitalizing software when both the following occur. So the first is management has authorized and committed to funding the software project. And two, it had to be probable that the project will be completed and the software book will be used to perform the functions as intended. So this is the quote, probable to complete recognition threshold under the new guidance. So in evaluating the probable to complete recognition threshold, an entity is now required to consider whether there is significant uncertainty associated with the development activities of the software. So the two factors to consider when determining if there are significant uncertainties, the first is that the software being developed has technological innovations or novel, unique, or unproven functions or features, and that the uncertainty relates to those technological innovations, functions, or features, if identified, have not been resolved with coding or testing. The second criteria is that the entity has determined what it needs the software to do. So, for example, what are the functions or features that the software is intended to cover? So this would include whether the entity has identified or continues to substantially revise the software's significant performance requirements. Those are all considerations as to whether or not he's met the criteria to capitalize. So also under the new guidance, the amendments specify that the disclosures in topic 360-10, which are the PP&E guidance, they are required for all capitalized internal use software costs, regardless of how those costs are presented in the financial statements. Additionally, the amendment clarifies that the intangible disclosures, which reside in 350, 30, 50, paragraphs 1 through 3, are not required for capitalized internal use software. So there's a little bit of diversity in practice and like what relevant disclosure guidance was being applied for this internal use software. And finally, the amendments in this subtopic, they do supersede the website development cost guidance and incorporate the recognition requirements for those website specific development costs it goes from subtopic 350-50 into 350-40. So for just reorganizing where that website and cost guidance resides in the codified framework. So the amendment, it applies to all entities that are subject to the internal use software guidance in 350-40. The amendment also applies to entities that account for website development costs in accordance with 350-50. And the amendments in this update do not affect software costs that are subject to 985-20. Again, that 985 section is relevant for software that is intended to be sold or leased. This is the external use guidance. So all that guidance is unaffected. The amendments in this update are effective for all entities for annual reporting periods beginning after December 15, 27, and interim reporting periods within those annual reporting years. Early adoption is permitted as of the beginning of any annual reporting period. One more note on some adoption here. The adoption approach on our next slide then is a little bit tricky, I'd say. So there's a couple options here, right? So this is definitely something you want to reach out to your Withum contacts, and we can help you walk through the options. The amendments are permitted to be applied using any of the following three approaches. The first is a prospective transition approach. The second is a modified transition approach that is based on the status of the project and whether the software costs were capitalized before the date of adoption. And the third is a retrospective transition approach. So under the prospective transition approach, an entity should apply the amendments in this update to new software costs incurred as of the beginning of the period of adoption for all projects, including in-process projects. Under the modified transition approach, the entity should apply the amendments in this update on a prospective basis to new software costs incurred for all projects, including costs incurred for in-process projects, except for in-process projects that, as of the date of adoption, the entity determines do not meet the capitalization requirements under these amendments. For those in-process projects, the entity should de-recognize any capitalized costs through a cumulative effect adjustment. And I think that might be a little tricky to apply in practice, depending on the nature and the type and sort of the granularity of the data you have related to those projects. And so those retrospective adjustments would be applied to the opening balance of retained earnings to the extent they apply. So I think in practice, with these three options, either a straight prospective approach or a straight retrospective approach might be the easiest options to apply in practice. But again, talk with your engagement teams and we can take a look at the data you have and to figure out what makes the most sense. I think my last note on the transition here really is just on that retrospective adoption approach. Under that method, the entity would recast comparative periods and recognize a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the first period presented. So that would require going back and sort of digging through some old data to determine what the differences are. But again, that might make the most sense for comparability purposes. Yep. So with that, I think we're going to just come on. But these are, so 2507 covers both derivative scope refinements and scope exceptions. And so there are concerns about how to apply the existing guidance. Under the current guidance, there are certain scope exceptions under ASC 815 for certain contracts, including those that are not traded on exchange. And the new guidance expands those scope exceptions to include contracts where settlement is based on the operations or activities that are specific to one of the parties of the contract. This likely means more contracts and embedded derivatives will be excluded from the scope of ASC 815 going forward. The FASB did note that the new exception does not apply to certain things like variables based on market rates or prices, variables based on the value of financial assets and liabilities, contracts to issuers on equity or calling put options on debt. And this kind of issue one about the scope refinements is effective for annual periods beginning after December 15th, 26 interim periods within those annual periods, early adoption will be permitted. For transition, you can apply it prospectively or using a modified retrospective approach. The prospective one applies to new contracts entered into on or after the date of adoption. The other one has a cumulative effect adjustment. And then once you adopt for modified retrospective, there's elections you can make an instrument by instrument basis on how to measure and account for derivatives under the new scope guidelines. There's also a second issue, the scope clarification for share-based non-cash consideration. The current guidance seems to lack some clarity about which guidance to apply when considering the share-based non-cash consideration received from a customer for the transfer of goods. And so the new guidance basically clarifies that you should be applying ASC 606 to these contracts when the types of consideration could be shares, share options, other equity instruments, and that using guidance in other topics like 815 does not apply to these transactions unless or until the entity's right to receive consideration is unconditional. This second issue is going to be effective for annual periods beginning after December 15th, 26, and for all entities and those interim periods with annual periods. The transition can be done on a prospective manner, again, for new contracts entered into after the date of adoption or using a modified retrospective approach. That covers all of the new ASUs that we have. And just briefly to give people an idea of the timeline, the upcoming effective ASUs, so those that are for annual reporting periods beginning after December 15th, 24, are listed here. There's the accounting for crypto assets that we've covered previously, not in depth today, but in the extras. Public business entities will also need to be adopting profits, interest, awards, disclosures, as well as improvements to income taxes, and non-public business entities looking at the accounting for income investments in tax credit structures and fair value measurement of basic securities that are subject to sale transactions. For next year, there'll be the induced conversions and the credit losses guidance that we did cover today. And then non-public entities will be implementing what the public business entities are implementing now. In the future, the FASB is really honed down to these 6 for the final ASU, final ASUs, which are expected to be released later this year, next year, including accounting for debt exchanges, additional guidance related to credit losses for purchased financial assets,
and as well as some kind of narrow scope improvements around interim reporting. The other two items on their agenda involve drafting an exposure draft for paid-in-kind dividends, and then there is currently board deliberations ongoing related to the statement of cash flows. So stay tuned for updates on all of that.